Let's talk about Disney, a company that's more than just a brand, it's a global icon. Disney isn't just about Mickey Mouse or princesses, it's about nostalgia, magic, and memories that span generations. People don't just watch Disney movies or visit the parks, they want to own a piece of the magic by buying Disney stock. Investing in Disney feels personal, you're buying into stories and experiences you love, not just a ticker symbol. Disney's empire is massive: Marvel, Star Wars, Pixar, ESPN, ABC, spanning movies, sports, and more. Their real power: synergy. A hit movie becomes merchandise, a theme park ride, a Broadway show, and a sequel. Each part of Disney lifts the others, creating a business model that's tough to beat. When you invest in Disney, you're betting on the enduring power of its brands and its ability to monetize them everywhere. From theme parks to streaming, Disney's deep connection with consumers makes it a favorite for investors of all kinds. That's why Disney stock is always in the spotlight. Everyone wants a piece of the magic. Disney went public in 1962, and if you'd bought shares back then, you'd be sitting on a fortune today. The company's early years were steady, but things took off under Michael Eisner in the 80s and 90s with hits like The Lion King. The real transformation came with Bob Iger, who led Disney's acquisition spree: Pixar, Marvel, Lucasfilm, and 21st Century Fox. Each deal made Disney's content library unbeatable and sent the stock soaring. But it hasn't all been smooth. Recessions and events like 9/11 and the COVID-19 pandemic hit hard, especially the parks. The pandemic forced Disney to pause dividends and rethink its business, but it also accelerated the launch of Disney Plus. Disney Plus exploded in popularity, proving Disney could thrive beyond parks and cable TV. Investors shifted from panic to optimism as streaming took center stage. By 2021, Disney stock hit all-time highs, driven by its direct-to-consumer pivot. Disney's story is one of reinvention, adapting to challenges and always finding new ways to grow. That's what keeps investors coming back. Why invest in Disney? First, its brands. Disney, Pixar, Marvel, Star Wars are cultural powerhouses. This intellectual property is timeless, creating endless opportunities for new stories, merchandise, and experiences. Disney's business is diversified: movies, parks, cruises, TV, merchandise, and streaming. When one area struggles, another often thrives, like Disney Plus booming when parks closed. The streaming segment, including Disney Plus, Hulu, and ESPN Plus, is a huge growth engine. Direct relationships with customers and global expansion make streaming a future profit driver. Disney's history of innovation, pioneering animation, theme parks, and now streaming, shows it can adapt and lead. The company isn't afraid to disrupt itself to stay ahead. For long-term investors, Disney's magic and resilience make it a compelling choice. No investment is perfect. Disney has its share of risks. The parks are vulnerable to economic downturns. When times are tough, families skip expensive vacations. Disney's massive acquisitions and streaming investments have piled on debt, limiting flexibility. The streaming wars are costly. Disney is growing, but it's not yet profitable, and competition is fierce. Creative missteps or box office flops can hurt the brand and profits. Disney also faces cultural and political challenges as a global brand, which can alienate some customers. Managing these risks while staying innovative is a constant balancing act. High debt and streaming losses are real concerns for investors. The company's future depends on making streaming profitable and keeping its creative edge. Disney's story has villains, and investors need to watch them closely. Disney may seem unbeatable, but the competition is fierce. Netflix is the streaming king, with more subscribers and a global content library, but it's streaming only. Disney's strength is its multi-pronged empire: parks, movies, merchandise, and streaming. Comcast, with NBC Universal and Universal Studios, rivals Disney in parks and content. Warner Bros. Discovery owns HBO, DC, and Harry Potter, but lacks Disney's family-friendly cohesion and park presence. Paramount and tech giants like Amazon and Apple are wild cards, spending big to win streaming subscribers. Amazon and Apple don't need streaming to be profitable, they use it to boost their core businesses. The streaming wars are a battle for attention, and Disney's brand power gives it an edge. But deep-pocketed rivals can change the game at any time. Disney's challenge is to keep innovating and leveraging its unique assets. The competition is relentless, and Disney can't afford to stand still. How's Disney doing financially? Revenue tops $80 billion a year, driven by media, streaming, and parks. Parks are the biggest profit engine, but streaming is still losing money as Disney invests heavily in content. The goal: make streaming profitable soon, which would boost overall profits. Disney's debt, around $50 billion, mostly comes from buying 21st Century Fox. High debt means more cash goes to interest payments, but Disney's parks generate strong cash flow. The company is working to pay down debt, but it's a key risk to watch. Major investments are focused on streaming content and expanding theme parks worldwide. Billions are being spent on new movies, series, and park attractions. These investments are designed to fuel long-term growth and keep Disney ahead of the curve. Financially, Disney is strong, but the pressure is on to turn streaming into a profit machine. Disney's money machine goes beyond movies and parks. Merchandise is huge. Every hit movie sparks a wave of toys, clothes, and products, much of it through high-margin licensing deals. The Disney Cruise Line is a floating theme park, charging premium prices for a unique family experience. Cruises extend the Disney brand and are expanding with new ships. ESPN is a sports media powerhouse generating billions from cable fees and advertising. As cable declines, Disney is pushing ESPN Plus and planning a full, direct-to-consumer sports service. Sports remain a must-watch live event, giving ESPN a durable edge. These hidden businesses add stability and growth beyond movies and parks. Disney's empire is more diverse and profitable than most people realize. What's next for Disney? The focus is on making streaming profitable and supercharging park growth. Expect headlines about Disney Plus subscriber numbers and new park expansions. By 2030, Disney's streaming bundle could be a global powerhouse, and new park attractions should drive higher profits. If Disney executes well, analysts see the stock rising significantly, possibly $200, $250 per share, by 2030. Looking to 2040, new tech like VR and AR could make Disney's worlds even more immersive. The parks will evolve, blending technology and storytelling for unforgettable experiences. If Disney keeps innovating, the stock could reach $400, $500, reflecting decades of growth. By 2050, Disney's brands will likely still be cultural icons, with new businesses we can't even imagine. The key: keep telling great stories and adapting to new tech. For long-term investors, Disney's future could be as magical as its past if it keeps executing. So, should you invest in Disney? It depends on your goals and risk tolerance. Disney offers unmatched brands, a diversified business, and a clear growth strategy in streaming and parks. For patient, long-term investors, Disney is a compelling story with big upside, if you can handle short-term bumps. Risks include high debt, streaming competition, and economic sensitivity in the parks. If you believe in Disney's magic and management, it's a reasonable addition to a diversified portfolio. Just remember, every great story has challenges and villains. Do your research, know the risks, and never invest more than you can afford to lose. But if you want a piece of a company that's defined entertainment for a century, Disney is hard to ignore.